May 8th, 2017, Personnel Finance Committee to order. Uh, Back here a page or two. Need approval of the agenda unless there's any changes.
Support.
Have motion and support. All in favor indicate by saying aye. Aye. Those opposed, the same. Passes unanimously. Thank you. We're on to item 3, public comment. We have no public comment, so we'll go on to item 4. First up on item 4 is approval of the minutes unless there are any changes for the April 10th meeting. Have a motion and support. All in favor indicate by saying aye.
Aye.
Aye. Those opposed, the same. Item 4B, the IT department. Welcome, Don.
Good morning.
Good morning, sir.
It's a pleasure to see all of you this morning. Before you this morning is a request to approve a payment to a vendor for maintenance of our backup system.
Payment is budgeted.
Yes, it is.
Any questions or discussion?
And it's nothing new, correct, Don? It's just ongoing year to year?
That's correct. I didn't bring it to you last year because last year we purchased another appliance which then took us over threshold.
So moved.
Support.
We have a motion for and support. All in favor indicate by saying aye.
Aye.
Those opposed, the same. Passes unanimously.
Thank you
Don.
very much.
Next up, 4C will be facilities. Welcome, Rick.
Good morning, Mr. Chair, Commissioners. In front of you, you have a request for permission to do municipal leasing to purchase vehicles. With municipal leasing, it's a funding mechanism where we pay so much either a month or a quarter or annually, and at the end of the term, for $1, we own the vehicle. What brought this up was the whole process of what Enterprise was asking us if we wanted to do leasing through them. The issue was, at the end of that term, the vehicles were owned by Enterprise and not by us. So when they sold the vehicles, they would retain what was called capitalized book value of the vehicle, and anything over that, they would pay to the county. But the flip side of it was, if it sold for less than the book value, then the county had to make up the difference. And that started the wheels turning, and when I was at the city police department, we used this method to buy undercover cars, and it worked well. The part that I like about it the most is it gives us the flexibility. At the end of 5 years, if we want to dispose the vehicles, we can, and we keep all of the proceeds. And then if finances dictate that we don't have the funding to spend for more outlay, then we would just keep the vehicles, because at the end of 5 years, the vehicles are still going to be in really good shape.
Okay, questions, discussion? Commissioner Elwell.
Rick, I normally call you if I've got questions, but these are all just kind of softballs and math, so I didn't. And if you remember, I wasn't supportive of doing the thing with Enterprise because we would have been using county funds to pay them, and I thought we could do what they were doing ourselves. And I'm not necessarily supportive of this either. I do support our getting new vehicles, but just doing the quick math on it, your documents indicate we'd be paying between 5% and 7% interest on
Yeah,
it.
correct. And again, we won't know until we secure the financing on it.
So the total that I get is $238,365. Is that about accurate for both? You got 85,000 ballpark and 153,000 ballpark.
Correct.
So if you figured worst case, 7% is $16,600 that we'd be paying to them to lease the vehicles. Correct?
Correct.
Yeah. So maybe the question is more for Mike than Rick, but why is it we can't find money in capital improvement or somewhere else to just buy these same vehicles that we need in the same way versus leasing them and spending more than $16,000 in interest, which is what I support doing if there's money to be found there?
Actually, Dave, the problem's been, as the numbers would come in for the 402 fund, that's what we use to purchase vehicles out of. A lot of times, the numbers we receive are not correct, or there's not enough funding in there to purchase the vehicle. Case in point was for the Ford Police Interceptor. The cost of it's $27,855, and yet in the 402 fund, all we had was $20,000. So it's one of those scenarios where, actually in this case, the Escape for the health department was $20,000, and the Ford Transit for the animal shelter was $28,000. On any given year, though, we'll have between $100,000 and $150,000 in there, but by line, a lot of times we just don't have the funding to purchase the vehicle that's been requested.
Mike, did you have input? Because isn't it really a matter of having funds to transfer into there?
What it comes down to is, the bottom line in simple English, is we don't have enough money. You know, we have competing dollars for the capital funds, and that's what we're talking about here. This way here, we can end up having all these new vehicles. We spend, you know, in the interest, we do spend that. But in the meantime, we have the use of the vehicles, as opposed to we can't purchase nearly this many vehicles if we have to spend cash. We don't have the cash up front on it. I was going to say it's why people, you know, finance cars, period, is most don't have the cash up front to do it. And we're in that same position. When you have to spend, you know, $600,000 plus on elevators and things like that, your money doesn't go too far when you have left over.
Now, one caveat to this, too, Dave, is the fact that through my deal, we're still purchasing these vehicles below dealer cost. So even if we end up paying a little bit more for them, we're still getting a very good deal.
I get that, and there's some police departments that do that too. I just don't like the idea of spending $16,000 of taxpayer money to finance it. But that's just me. But I do support getting the vehicles, so thank you.
Commissioner Rice.
Thank you, Mr. Chairman. So what you're saying is in the past, or apparently this has happened quite often, where we will, you'll come before us, or in regards to a vehicle being purchased or several vehicles being purchased at X amount of dollars, and at the end of the day, say it's $100,000, you find out it's going to cost you $130,000. You're saying that happens. That happen quite often, where the cost that you bring to us ends up being a lot more that we have to pay?
We would just have to shift the funding from, like Mike said, another area over.
Yeah, it's not the cost that they bring to us. The numbers they bring to you are accurate. What was budgeted is there's a shortfall there.
Okay, so we have a shortfall in the budget, and then you kind of alluded to this. Typically, if you lease a vehicle, you're going to be paying less over a period of time. So, educated guess, would that offset the interest that Commissioner Elwell's talking about?
It would certainly help to. And again, we're just talking in generalities because we don't have the exact numbers yet. As I said in there, our interest rate will be negotiated when we sign the contract.
If I may chime in there, just to be clear, there is no avoidance or way we can avoid that interest cost. You know, while we would pay less for the vehicles through my deal, or I should say while we will pay less than the average person through my deal, we would pay that whether we lease it or buy it outright. So the interest is a true cost to the county on it. The advantage is, of course, we get to use those vehicles sooner than we would have otherwise, where we may have to continue to drive or put money into a vehicle we'd rather not have because we can't afford to buy them outright. Whereas when you lease them, you get rid of the dogs and you have the new cars.
Are you done, Carl?
Well, just two. Two things. Is there a limit to mileage that we have to adhere to? And also, is there potential for an extended warranty on these?
There is the potential for extended warranties, and we have no mileage limits.
Commissioner Elwell, you got another question?
So, I do. So why would this be any different than going out and getting a loan for the cars? How would it be different if we were to purchase the cars and get a loan for them? We know interest rates are low. Why would we not do that? Which we certainly could get better than, 7%, I think, on a new car loan.
Well, and that 7% is a worst-case scenario. What Ford quoted me a couple weeks ago was 5.65, but again, that was through Ford. I didn't look at the banks yet. A lot of times they'll be a point lower, and I believe, Jim, you'll have to correct me if I'm wrong, as a municipal entity, I don't believe we can finance like a traditional car loan, and that's why they developed a municipal lease program. I mean,
Rick, is also, have you checked what is the total price out the door purchased, including what I'm getting at is the total price purchase plus $1, we get to use it for potentially 5 more years for that $1 purchase, correct?
that is correct, sir. And
Yes, we're paying interest, but we also end up with a car for $1 if we want it.
that's correct.
But Mike, is it possible that we have any internal funds we could loan it from and pay interest back? I mean, we've done that with other things, charging specific departments interest, but I just am troubled by paying out that much if there's other options, and I'm hopeful that we've explored all those. And really, having a 3-year lease, getting the vehicle at the end of the lease for $1 is no different than buying a car with a loan. I mean, essentially correct, if you can.
And that's the thing, we can't get a loan per se, a traditional loan.
The bottom line is, we're borrowing money. Call it a lease, call it a loan. It's the same principle. We're buying cars over time. Is what it comes down to.
And there's no internal fund that we could borrow from, like the treasurer who holds funds for municipalities locally and pays them a small amount of interest. Correct?
Yeah, there's we can get into that, but we're talking. Let's just say we're adding a whole lot of complexity to a small dollar amount figure when you look at the in total what we're talking about here. Because you're talking about borrowing money from like the delinquent tax fund or something, or general fund or whatever you want to call it. And in the end, I'm not so sure. Let's just say those things start to add up, and after a while, we won't be able to afford some of the other things.
Well, from my perspective.
Remember, the capital money all comes from there already.
Right.
That's where that money comes from. So what you're really saying is, let's just increase what we take from for capital out of the delinquent tax fund, which will create other problems and make us short on some of these big dollar items that we need.
Well, potentially, but it's also, you say that starts to add up. So does paying out $16,000 in interest with taxpayer dollars. And if the treasurer is managing money that pays out 1 or 2% interest, why not borrow the money from there and pay them 3% back? It's not like we take funds out of there for capital improvement projects, yes, but it never goes back in. But in this case, if we did it, it would be taking it out and also paying it back. But
Yeah, but
It's still consumable goods.
aren't we paying it back with capital improvement dollars? Are we, for instance, if we're making say an annual lease payment, weren't you using capital dollars to pay it back with?
Right, we're using,
So you're using the same dollars that you're using capital dollars to pay back the capital fund. It's the same money is what I'm saying. Unless we're going to say we're not going to use capital dollars to pay it back, we're going to use general fund dollars.
what are you going to pay the leases with?
I thought we were using capital dollars for it.
yeah, the 402 fund.
So it's the same money is what I'm telling you.
I guess I don't see the point if we're saving money, but So in the end, for me, I support getting the new vehicles. I'm not going to support the vote on it, but for what it's worth.
And one more thing, Dave, is just to purchase the 3 vehicles for the health department, the shelter, and district court would require an outlay of $76,000 if we just purchased some this year. They only had $33,945 in their budget. So, again, I can't.
Well, you can't buy them and pay cash for them, right? But
Correct.
they're going to pay those amounts over 3 years then, right?
3 or 5 or
Right.
4,
Right.
it depends what we come up with. Oh, well, always.
Commissioner Rice.
Thank you, Mr. Chairman. Okay, number one, I think we have, totally have 8 vehicles here?
Correct.
And obviously, based on reading this and talking to you in your office, these are vehicles that are needed, not tomorrow, but as soon as we can get them. And my perspective on it is that, like you just alluded to, the budget didn't have enough to purchase the vehicles that are required. And I realize we could take money from another fund, or we could take it from the delinquent tax fund, or what have you, potentially. I know we can't get a loan. We could take money from someplace else to help offset somebody's budget so they can purchase something. But I just don't like the idea of going down that road either. I just think if we start continuously do that, that's not necessarily a good idea. And even though we don't know for sure, I would think with leasing all these, that at the end of the day, because of leasing and getting these for $1, the concern that Commissioner Elwell has about the $16,000 in interest, I would hope that, quite frankly, again, it'd either be break even or we'd actually come out ahead, is the way I would hope. So, thank you. I will support this.
Any other discussion? I'd like to add, I have purchased large trucks to build a garbage truck with on programs like this. It seemed to work well. And, but I get tax write-offs too, and you can write a lease off 100%, not, you have to appreciate it. But it's worked well for me.
So
Commissioner
could I ask
Elwell?
one more question? We were having a side conversation
Go
here.
ahead,
So,
Peter.
yes, I am. Rick, so to be clear, what we're going to lease them for, it's based on the price, on the My Deal price, correct?
Correct.
So we'd be essentially leasing the vehicle at the same price as we would if we were buying it.
That is
Correct.
correct.
Thank you.
Plus the interest.
I would move to approve the lease with Gorno Ford. Well, it's a two-part motion, right?
Yes.
Basically. So do you want 2 motions or 1 motion? Okay, here's what I'm gonna do. I'll make the motion to move to the full board, the motions that are requested on the memo dated 4/24/2017 in regards to the lease on the 8 vehicles.
That was good.
Guess we're ready for a vote. All in favor indicate by saying aye. Aye. Those opposed?
Aye.
Carl, did you vote? Okay, passes 4-1. Thank you.
Thank you, Mr.
Thanks
Chair.
for looking at all the options, Rick.
Thank you, Mr. Chairman. What we have before you is a resolution that declares the official intent to issue limited general tax obligation bonds, or pension obligation bonds, and this is to finance all or part of the county's unfunded pension liability. And we are asking, the resolution talks about the amount not to exceed $75 million. This is larger than what we discussed at the study session, and the reason for that is just to make sure that our intent is large enough. It's likely that the amount of the bonds would be around $67 to $70 million. And the reason we don't know the exact amount is that our financial consultants need to review the latest actuarial report, which we received last week, which may affect slightly the amount of bonds that are necessary. The maximum amount of bonds, again, is determined by the state of Michigan. We have to go to the State Department of Treasury and get permission, and the state will determine the maximum amount. Again, this is just the first step in this process, and again, it's just the intent to issue the bonds, and this starts the 45-day rule in that we have to give notice of this, and then later actually has a resolution to issue the bonds. Now, discussions at the study session included the advantages and disadvantages of issuing these bonds, and I might spend a couple moments on the risk involved here. We speak of the debt service as a hard cost. In other words, the county is obligated to pay off the principal and interest of these bonds. If we do not, then we are in default. Obviously, that's a serious situation. So the idea is the bonds convert what you might call a soft cost into a hard cost. Really, a more accurate description of that would be that it converts a hard cost, that is our annual required contribution to the pension fund, to a harder cost in the sense that we have the principal and interest due. The annual required contribution to the pension fund, again, by, I believe it's state constitution, is required. While we can delay that, it would not be advisable that we delay the contributions to the pension fund, because that would adversely affect the funding levels and so forth. Issuing the pension bonds would also use up some of the county's debt capacity. However, we are still way below our total capacity that the county has based upon the assessed valuation of all county property. Now, the highest risk here is that the pension assets, once we issue the bonds and contribute the assets to the pension fund, then the pension assets have to earn a certain rate of return. One, it has to earn enough to break even. That is, let's say we are paying 2.6 or 3% interest on the bonds, and then there's some other issuance costs involved with the bonds. We have to make sure that we at least earn in the pension fund, let's say 3% plus in the fund. But in addition to that, in order to make us come out potentially in the end, the savings we discussed at the study session, again, is dependent upon the rate of return in the pension fund. And just to repeat here, historically, the pension fund has earned 7.4% over the last 30 years. Over the last 4 years, it's only been 4.8%. In 2016, it earned 7.8%. So our calculations, if that continues in the future, then the county would realize a savings starting in 2018 of potentially $1.2, $1.3 million. If the pension fund earns less than that, say it earns 6.5%, the savings is still around $1 million. If the pension fund earns, let's say, less than that, 6.5%, then I believe the savings is still around $600,000 to $700,000 a year. So again, the biggest risk here is that the performance of the fund is not consistent with historical trends. Yes?
I was good but you just lost me there for a
Okay.
second there.
The 5.5
Yeah.
If the, well, what I was thinking though, it sounded like the opposite of what you said. I was thinking that if we put 70 million into the pension fund, it is now fully funded, ARC goes to zero. If the pension drops, its return, we're still 100% funded.
Right.
It doesn't change the funding level. It's just the, dare I say it, arbitrage. It's the profit we make over what it costs and what we're investing for is reduced.
That's correct, yes.
So when you said 600,000, savings from 600,000 to a million, what does that mean?
Well, what I'm saying is that the less the pension earns, then the savings is less. In other words, instead of...
What
the-
savings?
The difference between the ARC and the debt service requirements.
Oh, but that's moot at this point, at that point. You're not even tracking that anymore.
You would, you still want to...
Well, when you have a fixed debt service of $5 million, we'll say, whether your ARC is zero. So whether it's,
ARC is always there.
the ARC is, no, the ARC would be zero because you're 100% funded. If you're 100% funded, you don't have to make an annual required contribution. You have, what's the other contribution you make?
Well, yeah, there's two components to
Two.
that. You have current cost, which is about $900,000 a year, and then you have the amortization of future cost,
Yeah.
which is the bulk of the ARC.
Right.
So the chairman is correct in the
current
sense
cost.
the ARC is still there. And you still could have years, say you have a really bad year, you could have a year where you're not covering.
We drop below
yeah.
100% funding, you mean?
Yeah, you would drop below that, and there may be an amount due.
Mike, can I interject a question
Yes.
here on that point? I mean, I got a list of questions, but that's one of them. So if it drops below, are we required to start paying that difference then, or do we make that up at the end?
You potentially would have to pay it each year. If it happens in any year where there's a shortfall, then you would potentially pay it.
Right.
However, you would get to count, not to, kind of complicated here, but let's say the fund does very well, then there would be excess and assets in the fund, which would help to cover the following year. the following
Okay,
year.
but it stays in the fund?
It would
correct.
stay in the fund, yes.
Means you'd be over.
Yes, potentially.
So when you have an off year.
So there, although we've talked about over time, you have to look at the historical performance, which I agree with. There's a potential there that if there were to be a retraction in the market and the bottom was to fall out for a time, there could be years where we do have to make up a difference, correct?
Correct.
No, that's on an ongoing year-to-year basis, correct?
Yeah,
I
it's-
think the plan is, over time, the averages will have us ahead.
Over time, I guess the question, Jim, if we go from 100% funded to 95% funded, and the ARC goes up, do we have to make the ARC payment? We're still 95% funded.
Well, I think we have to, whatever the actuary report would say, we would have to make that contribution to the...
Or,
Yeah.
because I know you don't have to make it, so, or what?
Or, or you don't make it, or you make it up later, which is,
Well,
some...
my point is the ARC, when you're at that level of funding, I mean, we're only in the 70s now, 70-something, low 70s.
76%. Yeah.
71% funded. When you're at 71% funded, missing an ARC payment is a big deal. When you're at 95% funded or anywhere close to that, it's not the big deal that it is at 70%, is my point.
But you don't want to fall back in the,
You never want to fall back.
you don't
but
want to
here's the
fall
thing.
back, and I mean, in the end, realistically, if we come out ahead, great, but I think it would be wiser for us to make that payment. If we did fall below, we should make that payment that year, and then at the end,
Well,
that
here's-
would be great,
Here's the
Doing
reason
it.
I say that, is because the market goes up and down like this all the time. it drops down one, and then, we have to make, whatever, $100,000 ARC payment or something. The next year it goes up, we don't get any of that money back, It's not like you go below zero on an ARC. So it's not like they're gonna ever issue a refund.
No,
you
but
know,
the fund
till the end, 5
increases,
years.
the fund
25
increases,
years
Mike.
Here.
The fund increases though, and then next year if it drops, then we're still funded. But
Well, my point is, over time, if every time it drops down, you make the ARC payment, I'm not saying we won't or shouldn't per se, but I'm just saying we need to understand the math on that. We make this ARC payment, and then over time, which over time is what we believe is going to be accurate over the 25 years, our fund will be well above the 100%. In fact, in the end, it takes 25 years, but when it finally ends, that's when the county gets the money back. In the meantime, we could be out, could be millions that's overfunded into the pension that the general fund has no access to.
Well, but let's hope over the first couple of years it builds that up so that if the bottom drops out. But
Agreed.
the truth is that we've never not made the ARC, correct?
That's correct.
Okay, and I think it would be an unwise thing to not make it. Because if you
At
think you're
70%,
having,
I would agree with you, but when you're at 100%, you got to take it into consideration at the time, And it depends. If we have the excess money, that's one thing, but if it's between an elevators and that, I might go with the elevator.
I'm thinking, well,
That's a future board, and hopefully we never have to go there.
or it could be this board for all we know, but
Oh, a
me,
future
for what
board,
it's
not
worth,
today.
I think we should plan on making the ARC every year, because if you have 1 year that's bad, what happens if you have 3 years that are bad? And then it starts stacking up, and is it have the potential to impact our bond rating? And the answer is yes.
Yes.
So I just think there's a chance for that to snowball, and, I'm going to support this in the end, but I'm glad we're having all these discussions so that we're all clear on all the potential things here and make sure we're doing the right thing. I've got several more questions, but if you want to keep going, and I'll ask them at the end, or are you at the end?
Well, I'm pretty much done, and be happy to answer any questions about this.
Oh, okay, so one of them, and I think you've addressed these, and I'll be honest and say I shared most of these with Mike before the meeting, so it wasn't a surprise. But the total amount is listed as 3 different figures. I saw 67 million, 71 million, and 75. And you've explained that because you don't know for sure what the total amount is, or interest rates, or any of that. That's the reason for that, correct?
That's correct.
Okay. And I had asked Mike the break-even percentage that the pension needs to earn, and you said that's about 3% or
Yeah,
so? Okay.
somewhere in there, yes, because of legal fees and other costs involved.
Okay, and then one of them was if there's a shortfall, paid when. That's up to us to decide. I think it's worthwhile for Mike to have the conversation about JC Dot, because the reality is that they're a component part of us, and their pension is somewhat segregated from ours, but it's part of the system, like medical care facility is part of ours. We have no control over that. We do have control over JC Dot, and that's what we're talking about, in fact, closing. And the reality is also that the amount of bonding that would be needed to pay off their obligation would be done separately and paid separately with road department monies, correct? Is that accurate?
The bond will all be combined, but right now.
I'm talking about the segregation of cost.
Yeah, they pay for their
Yeah.
share, and I assume that would continue.
Yeah, there's some discussion, actually, I have to disclose this to the auditors as a subsequent event from 2016, and we had some discussions about how you account for this, because I believe Oakland County and other entities have done this. And what you have is, because the ARC goes away, instead of pension costs that you charge out to various departments, you're going to have principal and interest payments charged out. So yes, there would be an appropriate amount charged to JC Dot, because that's a separate funding source.
And that should not be hard to calculate,
No,
correct? Okay.
It's just how we show it. It's really an accounting thing, quote unquote.
Okay, and the last, maybe I've asked it, maybe not, but so the figure inclusive of MDOT is part of the 67 or 71 or whatever? Okay, I think that's all my questions for now, thank you.
Mr. Latham, if we have 3 or 4 years in a row, the economy's doing pretty decent now, and we earn 6 or 7%. Then we have a couple bad years. We've actually built up a funding where we're maybe, by our earnings, we might be funded at 103%.
That's correct.
Okay, so if we have a couple bad years, as long as we don't drop down below the 100%,
Yeah.
we don't have to pay any extra. We'll
That's-
just let the average carry us
That's
through.
correct.
Okay.
And then is the tax liability at the end or that particular year? Because don't we have tax liability on the arbitrage? No. I thought we did.
Well, you can only, well, I don't think you do with respect to pension funds.
Okay.
And that these bonds are taxable bonds to the buyer of the bonds. They're not tax-free bonds. In situations where you have, tax-free bonds, you do have arbitrage potentially, but in this case, no.
Yes, the doctor don't have any questions. Any further questions or discussion, board? Are we ready for a motion? Okay, we have a motion and support. All in favor indicate by saying aye. Aye. Those opposed, the same. Passes unanimously. Thanks for the good explanations. Item E, it'd be our monthly finance report.
Yes, Mr. Chairman, these are the financial statements for the 3 months ended March 31st. So our budget benchmark is 25. Year-to-date expenditures so far are 12.8%. And this is a little bit below the 3-year average of 13%. So on the expense side, we are underspent at this point. On the revenue side, based upon the chart on page 4, we're pretty much on target year-to-date with respect to the revenue collected. Again, this is cash basis. We're still early in the year and so forth. And then I know there's been discussions here concerning the items where we're over budget, and we are going to address that with respect to whether or not the budget is correct and also whether or not proper amounts have been charged to that particular activity. And I'm referring to school liaison program that's over budget at this point.
Commissioner Elwell.
Thank you. I appreciate those comments, Jim, and I did have the discussion with the administrator before the meeting about that in particular. There's actually a couple of them there that are in the red. And so we had a fairly lengthy discussion on it, and I actually went back to last year's numbers on the school liaison. And last year, the revenue and expenses for that program were off by $100,000, almost. And I know that the administrator has told us that they're working on, and we're working without contracts that have been approved by the Board of Commissioners, which is required, correct, Mike? Yes. And you've assured us that you're going to have that for next school year.
Yeah,
which
we
would
actually
be-
have the agreements. They were drafted by, Phil Curtis drafted them for us. So we have documents now that it's just a matter of going to the schools and getting them approved for next year.
And to be clear, the plan is to word those contracts to fully recoup the expense of the school liaison, correct? Because I mean, things are so tight in the budget, and, you know, when we're risking road patrol, I'm not supportive of paying half the cost of school liaison. I support them being there if the sheriff wants them there, but whatever we develop has to recoup that, and I'm hopeful the board will support that proposition when it comes to us, and that the contracts will be clear. Can I ask if Jim is part of that, or are you part of developing the contracts?
Yes.
And you're confident, Jim, you're going to fully recover all the costs?
Yes, we make sure of that. And, yeah, and again, the first part is to identify that we have been charging the proper costs. And there's been a reason, not to go into a lot of detail, but individuals are switched from the school liaison program to Marine in the summer, and then there's also some issues, about timely charging of the salaries to the right entity.
Yeah, and I get that sometimes they delay that, but to be clear then, because I've heard that discussion about those deputies do Marine patrol in the summer, but to be clear, the funding financials that we look at are designed to fully expense and fully derive the revenue for the school liaison, correct?
That's correct.
Okay, thank you.
Move to pay the claims.
Just one brief comment. This is kind of a long meeting.